Welcome, everyone, and thanks so much for joining us for this month's State of Freight webinar presented by Averitt. My name is Mary Ann Hensley, and I'm the Vice President of Sonar Content Marketing and Media Operations at FreightWaves, and I'll be your host. I'm happy to be joined, as always, by FreightWaves founder and CEO Craig Fuller and Head of Freight Market Intelligence, Zach Strickland. Today's conversation will cover the latest insights from our Sonar platform, industry expertise, and what we can expect for the remainder of Q4. Craig and Zach will also be answering your questions live following our discussion. Before we get started, just a couple of quick items. First, if you have any technical issues during the webinar, you can reach out to our team via the audience chat function in your webinar console. And as those questions come to you for our experts, you can enter those through the Q&A box in your console at any point during our conversation today. And we will be sure to answer as many of those as possible during the live Q&A. We will also be sending a link to the recording of this webinar tomorrow in case you'd like to view it on demand or share it with your colleagues. And at this point, I will go ahead and turn it over to Zach to kick us off today. Let's jump right in, Zach.
All right, thank you for that, Mary Ann, and thank you all for tuning in. Thanks for Craig coming out today to do what he calls the favorite day of the month.
It is my favorite day of the month.
Yeah.
This is something I look forward to, hanging out with you, talking freight. What else could you want to be doing?
Yeah, I get it. I'm a freight nerd. I like to talk about the numbers of the freight. We've had an interesting month, to say
the least. It is it's interesting. Going back a couple of months ago, we actually talked about major brokerage failure and a compression in the market and a change in, we've seen a situation where obviously asset-based trucking companies have had enormous a number of failures over the years. It's a boom bust cycle. I can't remember the last time before this year when we saw freight brokerages actually fail, and not more just one, but we've seen at least 4 freight brokers have actually shut their doors in the past 4 months.
Yeah, and you actually kind of teased this out in the last State of Freight. And I think that's an interesting thing because I wasn't thinking about it either. We're always thinking about, okay, the capacity exodus, carriers leaving the market, but nobody's thinking about the connection between what brokerages have made between the smaller operators in the environment and larger shippers.
Yeah, it is interesting. It was a story that I've been following for a couple of months, and I had a number of people that are much closer to the P&Ls of the brokers tell me, and folks in that whole ecosystem, so bankers and others that were like, look, there is a systemic issue in the freight brokerage industry, particularly these high growth freight brokers. Not the private equity backed ones, the VC backed ones wasn't what they were identifying, even though we now know that's what a big issue. What they were actually talking was the asset-based lines of credit, the ABLs, where they had used financing and debt financing to really grow their businesses aggressively, and ultimately were in violation of their covenants due to margins. Now, what we now know is that venture capital brokers as well, and we had heard rumors for months about Convoy. That was everyone in the industry was talking about Convoy's situation. But I think we all were surprised at how fast that business deteriorated, or at least from the outside, looked like it had deteriorated much faster than what we all expected.
Yeah, and then, of course, the big question that everybody probably asks right now is how much is the market and how much is it us?
I think it's a fair question that every business should be asking. How much of it is the market and how much of it's us? And I think, look, I've been accused of it, or certainly have been done the same thing in my own businesses. When the market starts struggling, you start using that as a baseline excuse, and you start saying, hey, it's okay, business isn't as bad as it could be. But eventually you wake up and say, there is something systemically wrong that we need to fix. And I think as a business owner, this is the time to go do that. And frankly, no one, I got asked this morning, did we expect it to be this bad? And I couldn't remember what we said last year. And actually, somebody had asked me, an executive here at FreightWaves, when we brought him to the company last summer, did I expect it to be as bad as it is now? And I couldn't remember what we were thinking. We look at data so often and couldn't remember how far we have come or what we were thinking at the time. And I remember thinking that the downturn in freight was probably going to be at most a year. Like, yes, we knew it was happening, but I remember when we were having our first state of the freight, first couple of state of freights, plus what we were writing, we were talking about the fact that we needed about 12 months into the cycle.
Yeah.
And once we were beyond the 12 months, the inventory reset would be in order, and the market would probably start going up. It has not happened yet.
Right.
And now we look at it and say, this could go on a lot longer. You know, it's interesting if you've been a part of State of Freight and you've tuned into our past shows, you know, this is we're reading data in real time, and oftentimes you're having to draw conclusions. But I will say that this downturn has certainly caught a lot of us by surprise, as long and as hard as it is. I was looking at some data this morning, Zach. Do you remember where we were in terms of our state of the market back in the August conversation and September's conversations? Do you remember where we were at in terms of bullish or bearish?
I think you were starting to turn a little bit more bearish, and I was potentially getting into a little bit more bullish territory in September.
It's interesting because I was looking at data today, and if you looked at, can we pull up the volume chart for a second? Because I want to show this because I think it's really interesting in terms of where things are at. So if we go look at the volume data in terms of freight data, what's really interesting is, so go back and if you sort of look at it right here, we've got it on the screen as well. We're now high tech here at the studio.
I know, right?
We've upgraded to probably something we bought at Walmart for $100, but it's important here, right? But if you look at it, we saw continued gains through the first quarter to second quarter. And actually what was really interesting about this is that we actually saw this increasing level of momentum in third quarter. That is unusual.
Highly unusual.
And I think
even in COVID, that dies in July.
Well, COVID, I mean, if you go back to look at 2021, it's hard to draw conclusions on COVID. But you normally would not see this increase happen in the market.
Right.
But I want to pay attention to what happened in October. So and if you go back and look at the earnings reports, you know, JB Hunt had earnings reports. Some of the other carriers talked about green shoots, and I remember thinking, hey, we are moving out of the woods. It feels as if that was just a sign of an early peak.
Yeah.
And now things are back to being pretty ugly.
Right. Well, I think one of the things I was actually talking about in this demand side rise was an enormous amount of long haul freight run up. That 800-mile plus freight.
The intermodal has done really well.
And we saw that, you know, my last chart of the week was literally about there's probably some market share gain going back into intermodal now because this actually helps explain this dip. Being a little bit stronger in October.
I remember we talked about the coastal freight. Remember that? And there was a conversation that you and I had about whether this was going to be up or down. I don't think either of us had a consensus, like a real strong opinion, but it was interesting to sort of talk about this. I do think this is really interesting what we've seen in October is that we've seen the market slow down. And it's also interesting when you listen to the earnings reports that have come out, as well as anecdotal information that we're getting for the market, is that there was much more optimism in the first part of the third quarter that has now been muted, and everybody's sort of accepted this is going to be a long winter.
Yeah, and I think the fact that it was long haul freight to me kind of symbolized this replenishment volume. Yeah. The inventory replenishment. I thought maybe people might have overcorrected a little bit on their inventory destocking. And so they were starting to kind of pull forward. And the GDP numbers that just came out support that.
So what is so insane about the GDP numbers is that these are some of the most robust GDP numbers that we've had in history. In terms of and one of the strongest recoveries, 100%. You know, the White House will say this is one of the strongest recoveries in history. But you go ask people in the freight market, they don't see it.
Not at all.
They're not feeling it. And I think we can explain some of this through volume, but as we always do, we have to talk capacity because this is more of a capacity situation. If the GDP numbers are correct, and let's be fair about GDP. GDP in terms of freight movement is only about 40% of the GDP number can be answered through freight commodities. So what you're probably seeing now are services growth, substantial services growth. You're seeing government spending and stimulus that isn't measured in the GDP number.
That was my big question to Anthony was how much government spending are we seeing here? And there's construction everywhere.
Like they're building bridges, and some of that moves freight, but a lot of that shows up in construction employment, and a lot of the materials that, you know, when you're building concrete highways or whatever, you're moving those things over short distances. Like the concrete plant is, and the asphalt plant is usually pretty close to the destination of where of where they're actually building the project. So you're not seeing this sort of cross transportation or cross country transportation take place to the degree that you're seeing other types of parts of the economy.
Well, also we have to think about in freight. Last year, we were coming out of this overheated demand cycle. People weren't shipping stuff on the trucks anymore at that point. It was they were kind of like, we need to destock and get the stuff.
They stopped shipping,
and now they actually ran that inventory down and started shipping it again. So year over year, those numbers.
Well, those numbers start to be comparable, right? The numbers are back to sort of where they were, and
which would show a growth. And again, last year we were also in this non-recession. That it was a recession.
Well, it was a recession for freight. Look, everyone says there was no recession last year.
Right.
In fairness, the National Bureau of Economists changed the definition all of a sudden. It was used to be 2 quarters of subsequent decline. I think of back-to-back decline.
Of decline.
I think we had that by definition, and they oh no, that doesn't count.
No, there has to be something else too.
But freight has certainly been in a recession. Yeah. There's been a lot of this debate. I don't know if you followed this whole debate about what is a freight recession. Because now people are reclassifying. So Noel Perry at Truckstop came out and said, this is not a freight recession. The term freight recession is wrong because it's not a volume problem. It's a capacity problem. And I went back and looked at all the various definitions of freight recessions, a lot of them used to rebuttal my arguments. And it was interesting how people just have various definitions of it.
Right.
And there is no universal definition of what our freight recession is that everyone sort of accepts because everybody has their own version of it. That's something that I think we're never going to come to agreement, but it is something that's causing a narrative confusion of what a freight recession actually is.
Yeah, so I want to pull up this trucking authorities versus OTVI chart, and I have it pulled up here. And this is the total trucking authorities. Carrier details gets in there and kind of cleans up some FMCSA data to give us a total count of the operating authorities in the United States. And then right here is the monthly OTVI value. And you can see this, to me, this chart probably summarizes our current freight market environment better than any other, because what it's doing is showing you supply growth and demand contraction. But if you drew a line over demand back to 2019, 16% growth.
Yeah. I mean, look, we had a massive increase in capacity. We all know that. And it's still, to your point, we're still seeing a situation where it has not fallen back. I mean, if you sort of look at the numbers, you're up 48%. You're as high as 60%. You were, and that's it's been over a year.
Right.
So you look at that, and if you just sort of, it's hard to draw an exact correlation between these two numbers because they actually represent something different. But if you look at that, you basically, what this chart would say, just on quick math, would be about 2 years before it resets. Now, I did a study similar to this. Looked at the expansion cycle from 2010 to 2020.
Right.
And we added 199 new authorities per week. I wrote this article about it. From 2010 to 2020. So go back, way back when to 2020. And then we had this breakout moment in mid-2020 where it showed this aggressive curve.
Right.
Things just went haywire and went insane and hyperbolic, and we saw a massive expansion in capacity. And the number of new authorities jumped by 10x, not 10%,
right.
10x in terms of net new authorities of new additions per week, not total new authorities, but new additions per week. And now what we've seen is we've plateaued this really in mid-year last year. November of last year was about the peak of it. And now we're starting to bleed it out. But look at how slow that bleed out is, Zach.
I know.
And that's what everybody right now is feeling. They're seeing the GDP number. They're seeing the White House take victory laps. They're seeing economists and folks on Wall Street take victory laps because they're like, hey, there is no recession. And yet they're like, that doesn't explain my situation.
Yeah, I mean, in the freight market itself, it's always been about supply demand. And I've always said that demand is far more important to monitor closely than supply. Because of this. You see how volatile demand can be.
Well, remember, this is going to pull up or pull down. Like this pulls up or pulls down the authorities, like the number of trucks. So like as that increases, it naturally has, with a couple month lag, a natural pull on the freight market. And what's happening is this is inevitably pulling that down.
Right.
One thing I think is certain is the number of trucking companies that are in the market today is going to continue to reduce for a while.
Yeah.
It's going to continue to bleed out for a while. The thing that we don't know the answer to is how long will it take to actually get rid of a lot of the excess capacity. I did my study. I said 76 more, I think 78 at the time I wrote it.
Yeah.
We're halfway through that cycle. Like we have to go another 18 months basically before we see the market imbalance, if what I had said was right.
Yeah, I mean, so I want to pull up one chart here. The carrier details net changes in trucking authorities, the net changes in authorities. This is the chart that I'm looking at to kind of monitor the changes in capacity, the rate of capacity exit. Because we know anything in red down there, that's where authorities are revoked. Net authorities, I should say, are changing to the negative. We're losing capacity. This is growth in capacity, everything in green. And of course, the rate of red has not been close to the rate of green.
The rate of red is like we're reducing in terms of total assets. The number's like 460 authorities per week.
Right.
When you look at the fact that we were above 2,000 for a long time, and we have approximately 8,000 more trucking companies. Companies, not individual trucks. Most of these are small operators. We have 68,000 more than the market would suggest, the data would suggest that we need. It's a long cycle.
Yeah.
And I think what we all have to do in the industry is buckle up. We need to prepare our businesses for a long winter. And it's going to be much longer. The idea that this is going to suddenly turn around. Look, we have said it throughout this year. One of the challenges of doing this monthly and writing on a regular basis is sometimes you start to see data that looks promising and you're like, oh, we're out of it. I remember back in January, we were bullish. Like we turned bullish, like, hey, the data's reinforcing a turnaround, and it was a false positive. It was like
I wasn't as bullish as you were in January.
Well, then you go to the mid-year and it flipped, right? I was like, I don't know. And so it's just interesting how all of these sort of data points are very hard to sort of understand directionally where it's headed until there's a clear breakout. We just haven't seen it.
Yeah, and COVID, of course, kind of broke our understanding of a lot of data.
Seasonality, seasonal count is broken.
Right.
You know, I think next year is going to be interesting because we're done with the COVID high. We still have all the COVID excesses in the economy. And we're going to see that bleed out over time, slowly bleed out, I think. But as that happens, I think it's going to define things. I mean, one of the realities is, let's not forget, according to government data and the Federal Reserve's data, we're still in an expansionary economy.
Right.
Which means that interest rates are going to stay higher for longer. And it means that if we're still in a strong economy and the industry is feeling as much pain as it is, can you imagine if there is a sudden and sharp slowdown in the broader economy, what that would be for this industry? It would be catastrophic.
I mean, or it could just be, I mean, they're already kind of feeling.
Yeah, I mean, you would see a sudden washout of capacity.
Well,
like volume dried up.
That was going to be my next question. So another telling thing in this data set is every Christmas we see this washout, and that's a growth, and it just becomes less growth during the Christmas week. But if you look here, like we're due. I'm wondering. Well, what's going to happen here?
What you have, to be clear, it's not just a washout. There's just nobody coming in,
right?
Because the places are closed. Like the government, no one's adding. So, yes, it's true when they go off duty, they're not operating their trucks and they're sitting at home and like, hey, I don't want to go back out. I'm just going to park the truck indefinitely and I'm going to get out of this industry.
Well, it's a great jumping off point.
It is, because it sort of winds down the calendar, and January's kind of rough.
Yeah.
But I think it's hard to draw a conclusion that that is all just a bunch of people leaving. Sure. Because this is about net revocations.
Right.
Or net changes in trucking authorities. Remember, there's not a lot of people that are doing things between really mid-December, December 15th through January 4th. And so that's naturally, you would expect that to be the case.
Sure.
The bigger question is, what do we look on the other side of this? And I think if Q1 is going to be difficult, and I think it probably will be difficult, then it's going to mean a lot of failures. And we're starting to see the failures pile up. Like, they're not enough of them yet, but we are certainly moving into a period where we are reporting on a lot more bankruptcies than we have in the last 6 months. I remember... we had written a piece, both Rachel wrote a piece called The Great Purge last year. I wrote The Second Bloodbath Was Coming. That was actually predated my freight recession article. And let's be honest, we didn't see a lot of blood in the water last year. We're starting to see a lot more pain, and we're starting to see a lot of companies go under. And but we'll see more. And I think we will continue to see the market struggle to really gain its footing until we've reduced capacity, until we get to that, we about 20% more authorities need to leave the industry than we have today. Until we see that, I think it's going to struggle.
Yeah, well, so I want to pull up the Outbound Tender Rejection Index next here. This index helps, I think, describe the capacity environment possibly better than the changes in authorities, because that's a little noisy to look at times.
The changes in authority data is a good explanation, but it doesn't actually, it's not real time. It's based on a cleansed government database. It's hard to draw a ton of conclusions. It helps narrate the story. Often I view it as a data set tells you the why. Versus that, like, when. Although you can still draw some conclusions. This is much more hypersensitive to conditions of the market because it is showing the percent of loads that a carrier is accepting, or better said, the number of percent of loads that carriers are rejecting.
Yeah, and we've been down below, 4% largely. For almost it looks like since about March.
Well, it was a mid, down below 4%. This is the green line you've got here, right? Well, 3.51 is the green line, right?
Right here.
So that's the current baseline is 3.51. You were certainly below it in these periods of time. And as you
non-holidays
dropped it. But the low of the market, look at this, mid-May low. That was the very lowest point in the data, was that mid-May low. And we saw it recover. And I think this is where some of the bullishness came in, is that sort of recovery that was taking place. We're like, oh, we're out of, this is the start of a green shoot. This is the start of the market coming back. And what we've realized now is it was an early peak.
Well, and I think, too, the trend line is still there. We're still seeing rejection
it's
rates.
certainly not bad.
But it's not as bad as it was, which was on the ground.
Correct. But this is, there is no rules about how fast OTRI or no rules about how fast freight comes back. Everyone's talked about the 3-year cycle based on history. And that is a rule based on, decades of data, but the freight markets were different in those periods of time. You didn't have, so much has changed in the economy that it's impossible for us all to understand what has changed. If you think about it, we went from zero interest rate environment to one of the highest increases, at least in terms of increases off the low that we've had. You have inflation that's hitting, and you had this massive expansion cycle that unlike anything we've ever seen. A lot of the carrier executives out there and a lot of the people in freight have told me on numerous occasions that this recession is worse than the great financial crisis. Now, I've had a hard time reconciling that. I've heard that. I've even reported on it and retweeted it and written articles because it was an interesting quote. But I started to think about why they would believe that. And I was looking at some old data. When Yellow was going under, I was actually doing a lot of sort of investigation of the Yellow story, the roadway story, and all the companies put together. And I came across some old freight recession articles about the 2006, 2007 recession, that whole great financial crisis, because it's been so long since any of us were in, we're talking 15 years ago. And I realized and had, at this point, understood why that could be the case. So if you go back to that, we don't have the data to show you this, but we do have the data. We can talk about it. The freight market hit a recession in 2006. It was sort of the post 9/11, post Iraq War, but it really came into a situation back in 2006, 2007, where the freight market slowed down. And it predated the financial crisis. It was actually a warning about broader excesses in the economy were about to catch up. And then Lehman Brothers fails, and then 2008 is sort of the born-on date of the real financial crisis we know. And then the economy took a massive collapse from that point on. But one of the reasons I think that this has been so painful, that is more painful for many people than the financial crisis, is there was not a massive expansion cycle prior to the the true recession, the freight recession that took the second recession
Right.
of 2008. The great financial crisis entered at a point when the freight market was starting to recover from a recession, and all of the excesses had been eliminated from the freight market.
For sure.
And the market was more in balance.
Right.
This is different because what we have dealt with is a massive expansion cycle, and the slowdown that we've seen in volume is still not churned out. And unless we see that churn out, then this is the reason that the carriers feel the way they do, is that this feels much more detrimental to their success and much more painful than what it was during the financial crisis.
Yeah, so I guess to that point, are we at a stage, do you think, that, the freight market has arguably been in a recessionary phase since March of last year? I mean, the numbers...
Well, that was the freight recession article,
Right.
Would have been March 31st last year.
Right.
And it was based on sort of the Ukraine war, peaked in January, really came down, and then March was a disaster.
Yeah, but there was all this excess buildup, like from the success of the COVID era, economic success, if you will, of all these carriers and brokerages, and really just about everybody. And so the balance sheets were pretty padded.
They were great.
Yeah.
But there were also decisions made during that cycle which we're now paying the sins of,
Right.
or paying the price of. So let's go, the sins we're now paying for.
Right.
If you go back and look at it, when capital was super cheap, and I think you have to go back and sort of go back to the financial crisis because the cycle from 2010 to 2020 was this entirely different, a very unique period in time. Now you and I are relatively young relative to well, we're about middle aged, and that 2010 to 2020 period was an unusual period where interest rates were low. It was an expansion cycle for the broader economy, but cost of capital was basically cheap. And what that enabled is a lot of freight brokerages, and less so asset carriers, but certainly freight brokers, to grow their businesses and use debt to finance their growth. So they were using lines of credit, essentially, these ABL lines to grow their business. Many of them raised private equity, got really high valuations for it, and the PE firms piled on debt to do this as well. And what we saw was this massive expansion of the freight broker. And their interest rates that they were paying 4.5%, 5% during that period of time, today could be 10, 12, even higher interest rates that they're paying on that debt, and they can no longer grow through using debt financing. At the same time, you have the conditions of the freight market, volumes have dried up, and margins are starting to compress because of the rate spread delta is starting to move in. And I think that's why we're currently seeing a number of the freight brokers go out of business, because they simply cannot withstand the freight market fundamental changes as well as the changes to their own business.
Yeah, I don't want to forget the debt and financing aspect of this, but I want to pull up a chart real quick because I think it's topical on the contract and spot rate, because you're talking about margin compression. Now, this isn't necessarily margin, but it can be somewhat representative of how brokers make money.
This is the opportunity to make money. So it's this right here is the contract rate. This is the average rate across the U.S. that the carriers or brokers are charging shippers. And this is what they're buying that capacity for in the spot market. That delta helps explain a lot of the margin for the freight brokers. As we see that compress, because it will compress, and when it does, it will shrink the margin opportunity for freight brokers that are in the market.
Yeah, and I want you to talk about something we talked about a few weeks ago. And the contract rate itself, it was falling pretty rapidly, 13% year over year, but then it started plateauing.
It did.
So I want you to talk about why we think this has been so resilient.
So I had, this has been a journey for me to figure out, try to explain some of these data points, because they're different. And this is a new, I hate to use the word new economy, but this is certainly something new that we haven't seen before. in a normal cycle,
Right.
contract rates will continue to be, if spot rates are so low, they will continue to pull on that contract rate.
Right.
It is plateaued out really in the second half of the year. From July on, it's sort of like that drop has sort of plateaued out.
Yeah.
And it's been a mystery for you and I, and we've tried to like derive explanations. But I had a friend of mine who runs a very large freight broker that had a conversation. And what he pointed out was in the RFPs that he's doing for shippers, these are typically large, high volume shippers. 80% of the business is allocated to asset-based trucking companies, and only 20% is allocated to 3PLs or brokers. And what he said is that if you think about large asset carriers, because they're the ones that tend to get these larger RFPs, or at least a portion of the RFP, they are not willing to do a 30 or 40 cent a mile decrease in the rate. You know, they may take a 7 or 8% decrease. They're not willing to do a wholesale decrease. The spot market is going to reflect the clearing price of the market, what the carriers need to move their trucks. Right. Or what the carriers are willing to take to move their trucks, I should say. What we're seeing right now is more rational pricing among carriers, because in those RFPs, if we're only talking 20% of the freight being bid out to brokers, which means 20% is going to spot market, that 80% stays on the contract side, it means that those rates are pretty static until we have another bid. Right. And now we're in a bid season that's kicked off. The carriers are looking at some pretty difficult operating conditions, knowing they have to be more aggressive. We could, and I would predict, we will see that contract rate continue to come down next year. We will see, sort of look at the cycle. It's probably going to stay flat, at least this data point, stay flat probably through the first quarter, sort of look like it's bottoming. And those new bids, those new RFPs come into effect really in the second quarter. That's when we'll see the pricing reflect some more challenging conditions.
Yeah, and one of the biggest questions I get is, where do we see this kind of flushing out? Is it going to be another 13% drop? Is it going to be another aggressive drop? And the answer to that question is simply with the carriers themselves. They're the
I don't
ones
think
that
carriers
bid,
will ever take a 13% drop. They just don't. They're too rational for that. Like they know they can't operate their business. I mean, think about it. Trucking companies are operating on 3 to 5% margins, for the most part. Right. And because they're operating on such tight margins, they can't afford to take a 17% drop in rate. They will incrementally drop their rates by a couple percent. And when you go through 2 cycles of that, and potentially a third the following year, that's when you get those significant reductions. I want to say something remarkable. I don't know if you saw in the news on FreightWaves.com recently where Heartland's earnings report.
Yes.
Did you see this?
Oh my God.
This is a carrier, and I don't want to pick. I'm going to pick on Heartland. I don't mean to judge it, but I think it's really a sign of the times. Is Heartland, throughout my entire life, has been reputable to be one of the best operators, operating in the mid 80s always,
super clean,
even low 80s as an operating ratio. And it was one of the most fantastic operators in terms of capital efficiency and just profitability and operating ratio. It always below it. I think they had, over 100?
102.
OR?
They went from an 83 to a 102.
Now, they have bought CFI. They bought Transport America. 2 longer haul carriers. You know, Heartland tended to be more of a regional carrier or shorter lanes. CFI and Transport America were much longer haul lanes. CFI is north-south. CFI has a lot of exposure to auto, or at least it used to. I don't know if it still does.
That was going to be my next question.
Transport America does as well. But remember, a lot of the auto strikes didn't happen until really the second half of September. So I don't think the entire operating ratio challenges can be explained by auto. But it is interesting to say that Heartland, as much as it's struggling, is just a testament to how difficult the market is right now.
Yeah, and of course, it said in that article that a lot of those impacts didn't hit until like the September.
Oh, so it is. It could very well be auto related, but really, auto strike was what, third week in September.
Yeah, it's hard to account for that level of delta.
I mean, CFI was it was interesting because Celadon and CFI were always the big north-south bound carriers. And it was long haul north-south. That was like, they owned Mexico, that NAFTA lane. We know what happened to Celadon, rest in peace.
Yeah.
CFI has been, it's been changed ownership a few times because it's sort of like nobody really know what to do with it. It didn't fit the model. And now where it's at is part of Heartland. It operates different enough from their core business that I think it may be a more difficult asset for them to manage. But having said that, I think it's sort of a testament to the challenges that exist in this freight market.
Yeah. So are we, since we're going into the peak season, if you will, I want to pull back up the OTRI chart here, if I can pull it up, because I want to get your thoughts on, so last year we had tender rejection rates. We were falling. We were in a contractionary state. The market was softening. Tender rejection rates, we're almost there. We're getting closer and closer. But do you think this white line is going to get above this green line?
In terms of year-over-year tender rejection rates?
Yeah.
I don't. And let me explain why. I think, is it possible that we could see something happen in November, an inflection point? It's possible. I'm not going to make that prediction. And the reason being that if you look at the pace of these two rejection indexes, and we think about what's happening currently to volume, is volume starting to really, the gains that we saw in early July, or in July and August, and really bounce back for May, we're losing a lot of that momentum. I think retailers are much more, they're playing defense this year more than they had even last year. Last year they needed to liquidate a lot of inventory because they had excess inventories. But this year they have been pretty reluctant to sort of create too much inventories because of the uncertainty among the consumer. Now, according to their data, the consumer's doing well, but I think everyone's still playing defense because nobody knows how long this is going to take and how bad the economy could get. So I think what's happening is retailers ran a lot of peak. They ran an early peak season. I don't think we're going to see a ton of demand. I also think there's a psychology element in trucking right now that is different than even last year. I remember last year I think it was September of 2022, where the CEO of Ford Air was at an industry conference and said, if this is a freight recession, bring it on. Like he said this in September. It was late August, mid-September. I can't remember the exact date, but it was that period of time in September. If you go back and look at Q3 of last year, there was still a lot of hopium in the market. There was still a lot of a lot of folks denied the state of the market. And even in the fourth quarter, even when things were really slow relative to where they had been, there was still some companies and executives talking up the market. Like, it's not so bad. It's not going to be so bad. I think all of that's gone. And if I'm making decisions on booking my trucks, I am taking every load that I can get to move my trucks. I'm telling my people to just keep adding. And I think that's why rejection rates will stay relatively low, because it means that carriers are biased to basically taking freight, even when the conditions may be, the rate may not be great. And I think that bias and that mentality has changed the way they're operating. Here's one more fact, and I think this is also really interesting, is that we are hearing that a lot of larger fleets are actually parking trucks. I've heard this from recruiters. I've heard it from anecdotal channel checks.
It's on the earnings reports too.
They're setting the trucks. They're not hiring drivers for the trucks. They would rather have trucks sit against the fence, which is that violated everything I knew about trucking. Was like, you let them sit against the fence. Like, you're not supposed to do that. The rules are keep the equipment running. But they're making the decision, rather than hire the drivers, rather than fill those trucks, let's park them against the fence and hold on to them and not utilize these trucks and not put miles on these trucks because we simply can't make a profit right now. That capacity is available, and these trucking companies will react to those conditions. They will hire the drivers when they have the demand for it. When that happens, that will keep that anytime we see an increase in volume and demand, they will add those trucks back, and it will be whack-a-mole to the rejection rate.
Wow, that's a big one right there. Like, if they're truly sitting, and it looks like they are according to their earnings report.
I mean, what did you see Knight-Swift's numbers?
I didn't see I don't remember their exact count. I remember JB Hunt went down about 200 units, and they're not a huge.
But what about one
over
sitting?
the road.
Did they
and
talk
then
about sitting against the fence?
No, they didn't talk. No, they actually
You're talking about shrinking their fleet
shrinking
size.
their fleet size.
Now, what I'm talking about is different than that. I'm actually talking about them sitting against the fence.
Yeah, that'd be crazy.
They're doing it. Where I'm hearing it. I heard it anecdotally that it was happening at a number of large carriers, and then I heard it from some recruiters that say they're not recruiting; they are sitting the trucks against the fence. That is different than what I would have normally expected. It's certainly different than the rules that I grew up learning that you run.
Yeah, because
trucks.
the trucks cost money.
They do, but remember they finance these trucks at relatively low interest rates,
Right.
And they have a finite number of years that they'll operate them, but it's really about the number of miles,
Right.
And so if they can hold on to the trucks a little bit longer, it defers their CapEx for new trucks, but it lets them right-size their fleet. Now, if you have a lot of debt and you're operating in the margins, you really can't do that.
Right.
But if you're a carrier that's well-capitalized, has a huge balance sheet, and you have solid operations, you can actually do that and sort of get away with it for a longer period of time because you simply don't want to put miles on those trucks.
Interesting. So I want to bring up another chart here, and this is gonna feed into this peak season mentality. We've talked about inventories a lot. That was kind of the narrative earlier in the years. Like, we're going to run through these inventories, and then all the demand's going to come back online. This is the LMI, the Logistics Managers Index, inventory levels component. Anything below 50 is contraction. Anything above 50 is expansion. Since April, this index has been in contraction status. OTVI, you can see the connection here. As they were moving a bunch of stuff, and then they stopped moving things as inventories were building up. And then it looks like we bottomed out, and now inventories, this is where the overcorrection of inventory thought came into my head. Do you think that inventories are stable where they are?
I think they've drawn down the inventories. Remember, this is a diffusion index, which means it's based on relative to, am I in the future, in the next month, am I going to be higher or lower? So diffusion says that they've drawn them down, they continue to draw down, continue down. I believe that inventories have corrected.
Okay.
I believe that what we saw in that Q3 increase was just some replenishment, some sort of forward positioning of inventories into their supply chains ready for it. Let's not forget, we talked about it last time, but let's not forget that China faced significant economic headwinds when last year, when demand dropped out of the U.S. market. And a lot of those Chinese manufacturers became very aggressive in trying to cut deals to move product, to move inventory, because their factories were sitting idle. They wanted to come back to work and build. They were able to cut a lot of those deals, and those big box retailers did that. I think what we saw in really early part of Q3 is right before Labor Day and into late September is an enormous push for that inventory for the holidays. And I think retailers are going to sit and manage the inventories that are in their supply chains, but they're not going to be adding significant amount of volumes.
Right. And I'm looking at the ocean, the IOTI here real quick, because this tends to support the thesis that,
IOTI.
Yeah, we've got, so this measures 20-foot equivalent unit containers coming from all over the world into the United States ports. And it supports that early run-up that we were talking about.
Henry Byers has talked about the early run-up. So basically, you're running up here. You saw this sort of early peak.
Yep.
And it's interesting because just like we did in trucking, there were people like, oh, we're back. We're back. And maybe we are back better than we were.
Sure.
But I think what we're actually seeing here is what we talked about is an early peak.
Yeah.
The good news is that, sort of the facts are that freight came into the economy, came into the U.S. ports, it went into warehouses, went into distribution centers, went on rail intermodal. The rail intermodal data has been really strong. It has done well compared to the rest of parts of the freight economy. And it's telling us that those long haul lanes and those imports are actually holding their own and doing quite well. And we're not seeing it for the broader part of the freight economy because frankly, when intermodal's cheap, it also benefits from higher fuel prices. Do you know why that is, Zach?
No. Yes.
Do we want to explain why they benefit from higher fuel prices?
Go for it.
I was going to let you do it, but I'll do it. It's because of the fuel surcharge.
Yeah.
The delta between the fuel surcharge and on intermodal and the truck fuel surcharge.
It doesn't increase as fast.
It doesn't increase as fast on a different base. And so as fuel prices increase, it becomes more expensive to move it by truck
Exactly.
than it does rail. And that is why the fuel surcharge index or the fuel cost increases can actually drive more freight as a modal mix into rail versus into truck.
Yeah, and I think we have to mention the rail. This is loaded container volumes moving throughout the United States. The rail sector has really had a late blooming this year.
But it's because I have no urgency to move my freight.
Right.
Like if I'm not urgent to move it and I can save 40, 50 cents a mile, 15 to 20% of cost, whatever the delta is today, then of course I'm going to move it on the cheaper mode of traffic, particularly when service and times aren't important to me.
Yeah.
Like everybody knows that if something needs to be moved and shipped out immediately, that rail is not your option. But everybody also knows that when it's cheaper and time isn't required, or service isn't a priority for you in this particular type of freight, then you move it on rail, which will be cheaper and save you some money.
Yeah. Do you think this is going to impact trucking significantly?
No, I think like in terms of the gain share element.
Yeah.
No, I think this is rail intermodal is a small piece of the overall trucking market. Like you're talking about a $25 billion industry. Like it's smaller than LTL. It's just not a huge factor in terms of total freight. Right. I think JB Hunt has like almost half of that market, or at least they have at least a third of the market. Yeah. Hub Group probably has the other lion's share of it, and then everybody else is there. Schneider and Knight also have some of it. But like once you get beyond JB Hunt, Hub Group, Knight, and Schneider, it's a really small market.
Right.
It's a very small micro market. So I don't think it eats into trucking. Yes, at the margins it does.
Yeah.
And I think truckers would like every single load.
Right.
But not at a level that anyone feels.
All right. Well, I want to pull up one more thing before we get to Q&A. This is going to be the NTI and the forecast. And the forecast uses a couple of upstream components, suggesting that peak season won't be that huge, at least yet. We're getting into the front edge of this forecast for Thanksgiving.
It's a weak peak, man.
It's a weak
10-cent increase. Woo!
Yeah, so we got a 4.5% increase forecasted here for the moment.
But look at this puppy. Like go back to last year and we're at what, 258? Where's that?
That's
26 cents a mile.
Yeah, this is Christmas and this is Thanksgiving.
So you're looking at November, right?
Yeah.
Thanksgiving. So what was that one? 12 cents? I mean, but last year was also pretty sad.
It's pretty sad.
And this is saying 10 cents.
So the rates aren't going to recover.
No,
all the way back.
No, but like no one ever thought they were.
Right.
Like who thought they were?
Right. But I think it's interesting that this is basically saying, nah.
I mean, look, there was a moment in time this year where I actually thought this is going to be a peak season. It was going to surprise us all. I was wrong. Clearly.
We're not there yet.
Well, good. I can tell you, I was wrong. I'm going to make a prediction that I was wrong. I was thinking when we saw the increases in volume in July and August that, hey, it looks like a recovery's in place.
Yeah.
I was wrong. And what has been difficult to sort of understand, and it's forced me to dig deeper, is the reason I was wrong is I don't think any of us realized how much capacity was in there. That new net revocation data that we've got has been some of the most eye-opening data because it's telling us, and I didn't have that when we first making some of these predictions. It's telling us that it is lower for longer, and that this is going to be a much deeper winter than any of us ever expected.
Right. All right. Well, I want to leave time for Q&A, so I'll toss it back to Marianne.
Awesome. Thank you both so much for the conversation and analysis. As Zach mentioned, we'd love to take some questions from those of you listening in. So if you've not already submitted those, you can do so through the Q&A box in your webinar console, and we'll cover as many as time allows. First question we have for you. Is there any end in sight for the freight dip?
Well, is it a dip? I mean, it is a big dip. Is it
Crater?
Yeah, it's more of a crater. It jumped off a cliff, as we all like to say. Is there any end in sight? No. If we let's use the term dip and be fair to the questionnaire, the question seeker. Look, this is not a dip, but if we call it a dip, what you're talking about is our volume's going to recover back to 2021, 22 levels, if that's what we're defined as. And the answer is not for a long, long, long time. And so even getting back to a point where you have more rational pricing that's above cost, and a fair margin where somebody's, a trucking company is able to make a sort of a living wage and then a little bit of margin, it's going to be a long time. And I hate to say that because no one likes negative news, but there's no data point currently that suggests that this is going to be a quick recovery. It is, like, we all want it to come back. I mean, like the thing that I think a lot of people are confused by is FreightWaves, and I'm the CEO of FreightWaves, we do not benefit from a soft freight market. Like, advertising becomes harder to sell. Data becomes more challenging to sell. I want it more than anybody to come back. I want to talk about something on the upside. But right now, we're just going to be in it for longer. And I think you need to prepare your businesses lower for longer. And there is not going to be a significant increase in freight. It's going to be a long drive.
Yeah, I mean, the capacity has to come off. You see how slow it is to correct? Capacity moves at a much slower pace than demand does.
And there's a reason for that.
Yeah,
I mean, drivers have gone out and borrowed money. Like, think about if you've ever had a cash crisis in your own life, you're going to do everything to figure that out before you file bankruptcy or start defaulting on things. And I think what's happening is it just takes a long time to get rid of the excesses because they're committed to being in the industry.
I do think some directional changes will happen next year, though.
Some hope, optimism, which is good.
Awesome. Thank you both. And next question, with respect to the revocations part of your conversation, we have someone asking, how are the net changes in authority affected by the number of fraudulent carriers added?
It's a good question. I don't have the data. Our friends at Highway could probably tell you that question answer better. I don't have the data. I would be reluctant to make an educated statement on that. If you take the revocations data out of it and you look at the number of trucks added, this data point tracks in terms of FMCSA registered VIN numbers.
Right.
Is it possible that those VIN numbers could be faked? It's a lot harder because those databases, government databases, do a much better job of policing it. And I'm not a database expert in terms of FMCSA data or MVR data, but I will say that there's probably and likely, and I believe this to be the case, some level of fraud in that data, in these data points. I can't prove how big that number is, and I would stretch to even make a guess.
Yeah, I don't think that's significant. There's a couple of eyes. It's not just the government that's on this. It's carrier details. So there's a few levels of cleaning going on here.
And it's insurance data. They have to.
Yeah, they're backing it. Yeah, they're also utilizing.
Yeah,
some other.
And so, like, someone's not going to pay much of an insurance.
Exactly.
So, yes. Do we think that these numbers can be skewed artificially? Absolutely. I don't think it's significant enough to actually skew the result.
No, not at all.
Perfect, thank you. And next question, do you expect capacity to continue to drop during the peak months?
Do we expect capacity to drop during the peak months? I would sort of rephrase that answer to say it is going to be a challenging peak because capacity is readily available. I don't see there being a capacity crunch,
right,
even in peak. And therefore, I think it's going to be a challenging peak season for a lot of carriers because they're not going to find high-paying loads like they have in the past. And I think shippers are going to find an abundance of capacity out there to haul their freight. And therefore, I think everyone in the trucking industry, asset-based carriers, should be playing defense, not offense right now. Yes, we would love to charge 2-3x what you're normally charging, add another $1 a mile on just for giggles. You're not going to get it this year.
I think we're going to see some fundamental changes in the spot market. We saw this last year in the way that the mixing of the type of freight in the spot market becomes a little bit more unbalanced into the ad hoc, I got to have this sense of urgency, kind of returning. And that changes the figure of the NTI over this period of time. And I think it's a little misleading in the way that it suggests that we're getting very tight. But I think it's really just a mixing. And again, with some of these operators deciding whether or not to park their truck through a slow period, they're going to have to find freight that covers their cost and makes margin to get them on the road during this period of time. So what that does is the average of the spot market rate actually does go up higher, but it's not necessarily a definition of like the market getting tighter.
Well, one other factor in that is length of haul.
Yeah.
And the origins play into that national average.
Sure.
Because as
Shorter
you
haul.
think about, just think about the cycle, the calendar, if you will.
Mm-hmm.
Early in the peak season, in September and really early October, maybe even late October, the West Coast is still pumping a lot of that container freight into the economy. By the time you get to mid-November, most of your West Coast freight has sort of not dried up, but it's slowed down. And therefore, the length of haul changes. It actually, and what happens in relation to that is The rates, because the volume shifts from concentrated on these long haul lanes to these regional lanes, these sort of mid haul and shorter lanes, as we make the final mile deliveries, that will increase the overall rate in the total economy, but doesn't change any of the factors. So we could see an increase in rate, maybe that's what we're seeing right here, to a degree, but not see a fundamental shift in how the market operates.
Yeah, I don't think the market, just because if we see rates go up, I think you're going to get holiday premiums too.
Yeah, and you always see that.
Yeah.
That's very well, if you're looking at that's Thanksgiving, you're getting some of that too. It's just not the double the premium, the good stuff,
Right.
when it was fun. Yeah, none of that stuff. Fun if you're selling it, buying it.
And we've had a couple of questions come in around LTL pricing. Matthew says LTL has largely remained insulated because of the limited number of carriers in that mode and their commitment to maintaining pricing discipline. The question is, will the softness of the overall freight market get down to a point where LTL carriers will start to come down on price?
Absolutely. It will. I think one of the things that you're seeing in LTL, one, it's always slower than the truckload market to react. We were just starting to see LTL pricing come down in like May and June, right when the yellow stuff started really taking off. And this kind of propped that market up a little bit. And I think we're still dealing with some of these carriers, gobbling up that capacity, gobbling up those customers. And it's disruptive to networks. LTL networks are very fragile and sensitive to these types of disruptions. So we do think that market's got some, a little destabilization in it right now. But I think what the question is going to be, when that dust settles, what's the trucking market, or what's the overall truckload market doing at that point in time? And that will determine what happens next.
I agree. I mean, you're losing yellow at 10% of the overall LTL capacity. You're naturally going to be in a better position from a pricing standpoint.
Yep.
One other thing to keep in mind is yellow, even if you just take the numbers out of it, yellow was the bottom feeder to the market. It was setting the low of the market. And it was reluctant as a company to increase those rates. That's given the LTL companies, at least on the lower end of the market, some pricing power. At the upper end of the market, not so much, but it does mean that the overall market can reset pricing slightly higher. But in terms of whether or not they'll be fighting for I think the big question, Zach, and I think I'm going to leave it with one big question, is what does the U.S. economy do next year?
Yeah.
And we've talked about as if this is stasis, as if we bleed out capacity and volumes stay about the same level and maybe they increase slightly. We haven't talked about a scenario, like, first of all, let me ask you real quick. We just got a few seconds. Do you think we will see a surge in the freight market in volume? Is there any catalyst to drive a surge?
No.
Short of a big catastrophic geopolitical event, I happen to agree.
Yeah, I mean, unless...
And let's, heaven forbid that we don't want that.
Or they start cutting rates and signaling like they're going...
You mean the Fed?
Yes.
Yeah, the Fed, but why would you do that? It's because they think the economy is slowing.
I don't know.
Which is actually bad for GDP.
Right.
Maybe if there's a major military conflict, it could drive demand. Short of a catalyst, you're not going to see volume increases. So because of that, I think the question then remains, we have much more risk on the downside of the economy slowing down and falling apart.
Yeah, for sure.
And that could really hurt freight.
Excellent. Well, everyone, that is all of the time that we have for today. So Craig and Zach, thanks so much as always for being here. It's always great to have you sharing your insights with us. Special thanks as well to Avrit for partnering with us on today's webinar. And we appreciate you and our audience for participating and asking so many excellent questions. Finally, just a quick reminder that our F3 Future of Freight Festival kicks off next week, November 7th through 9th, right here in Chattanooga, Tennessee. Visit events.freightwaves.com to get your tickets. We'll also be hosting a live in-person State of Freight at the event, so we hope to see you there. Thanks again for joining us.